Micah, I really appreciate you joining us today. I know this is kind of a long time coming. You and I think, connected in VC chat like a while ago about this and the idea of you kind of coming on and then giving some inspirational tax talk, some tips, some help, because you're a pretty accomplished person. You have books on crypto and NFT when it comes to related to taxes and stuff, and really excited to talk to you today. So if you wouldn't mind, just a quick introduction, and we can get started.
Yeah, I mean, I'll keep that pretty short. CPA, been practice on my own or we've got a firm, there's 5 of us, but on my own since about a decade now. Up until started working with crypto a couple of years. Before that, really specialized in online businesses and really growth-centric businesses, which is part of how I got into crypto. Is a lot of my clients, just because they're tech adjacent, were interested in it. So about 2020, really got deep into crypto, realized there was jack crap out there in terms of actual guidance. The little bit of guidance that was out there just read wrong based on just logic and taxes. You could just tell it wasn't written by professionals who understood it. So yeah, that's been our main part of the practice my main part of the practice for the past couple of years, and trying to think of most notable things. We got the book. I do stuff with, people love or hate Ty Lopez, but he'll have me on every couple months to talk to his NFT group about the tax side of stuff. So yeah, I mean, just got into this as a hobby and ended up being more profitable for me than my actual not so great trading habits within crypto.
That's awesome. No, I'm happy to hear that you were able to not take advantage. I don't want to make it sound like that, but you're able to come into a space that is very often misled, whether it be from other people or from their own, just, I don't know, jackass knowledge where they think they know it, but they really don't. Could you maybe elaborate a little bit on what you were seeing when you kind of came into this? Like, what were some assumptions people were making that maybe were completely wrong about crypto and NFTs when it came to, like, reporting it on your taxes and things like that?
I mean, there's obviously like the thing, like the crypto bro 101 is that, like, oh, you don't have to pay tax until you cash out for fiat, which is nonsense. And one of the things that the few things the IRS has issued explicit guidance on. But even just like NFTs, the IRS has issued no specific guidance on it at all. But the little bit you will read, and it's pretty sparse, if a tax professional will wade into the arena, they'll say that NFTs should be taxed as collectibles. And what happens with collectibles is that regular capital gains max out at 20% if you hold them for over a year and you get long-term capital gains. Collectibles are 28% instead. And for a lot of NFTs, especially for just like the straight profile picture, like JPEG versions, that's probably right. But that's putting NFTs, which can be like a million different things, into this one bucket. Like the Metaverse HQ, I'll use Metaverse HQ as an example when I'm talking about, you're paying for a membership. Like, yeah, you're getting an NFT, but you can't, putting that in the same bucket as a Bored Ape or some NFT that has utility within the gaming or the metaverse, if that ever really gets like going, they're completely different use cases. And so there's you don't see any. Basically, what will see is it's either people who don't understand taxes pontificating about it, or it's tax professionals who don't understand blockchain and clearly aren't involved in it at all.
Understood. Got it. Well, I would love for you to kind of walk us through exactly what we should be expecting this year. But I also want to kind of make this a little bit more conversational. So if you don't mind, I like to ask a question because this has got me kind of scared shitless, and not really, but I feel like a lot of people are nervous about taxes, especially I will say that I'm a 32-year-old man, and until 2 years ago, I've never quite I've never quite handled this much money in my life before, right? And one thing that I'm kind of scared shitless on is, am I doing it right? Am I doing it in a way where, years down the line, it turns out I like slipped up and committed fraud or something like that? So can you tell us what, maybe like what exactly is tax fraud versus like not paying taxes? Is because I feel like it's a common misconception when we're like, I haven't paid my taxes. And they're like, well, you're going to go to jail. If I'm not mistaken, that's not a thing, right? We got rid of debtor prisons a long time ago. It's just when you're trying to move money around to fake things, if I'm not correct. So,
right.
so
well, I mean,
right.
Tax fraud largely goes to intent, right? So that's one of the things, especially because crypto, there's not great guidance out there. If you're reporting your crypto in one bucket, or you're taking this accounting method, or you're doing stuff that the IRS hasn't issued specific guidance for or against, but you're at least reporting the freaking income, you're going to be fine. Like maybe the IRS audits you, maybe there's a new revenue ruling or something that comes out that says like, hey, the way you did it wasn't right. But so long as you're showing that you made an honest, good faith attempt to report it, then you're not going to jail for that. What they're going to do is that in the off chance you get audited, which is very unlikely, but you can't say it's impossible, they're going to hit you with the tax that they think you should have paid anyway, and then about a 25% penalty on top of that. So, I mean, that sucks. Like, nobody wants that, but you've got a less than 1% chance of being audited. So that's not something, like, I want people to be smart, and obviously this is my whole career, so we try to do everything and have it as buttoned up as possible, but it's also not something I want people to lose sleep over, that they're going to prison. Where that would happen is if you're clearly and recklessly and just with like wanton disregard for the law trying to hide and obfuscate your assets and just actively refusing to report your activities and the income you're generating.
What if I personally feel like taxation is theft? Am I safe there?
Going sovereign citizen. Yeah, I mean you'll be screwed if they find you with that. So, I mean, it's one of the things that we will talk about. And like, I'd love if people have specific questions. Like, basically, whenever I do these, like, I can drone on about whatever the hell I think might be of interest, but it's not what people are actually wondering about. So, I don't know how these usually go, but if to the extent people have like specific questions, I'd love to or you do, like, love to like get into those more granular things. But one of the things that like you'll hear all the time, and people will message me like, basically trying to get me to help them commit tax fraud. Like, is the IRS really going to do this? One of the things you'll hear all the time is like, well, I'm doing it on DeFi, so nothing's getting reported to the IRS, which is true enough. It's not like you're on Coinbase or Binance or something, and a 1099 or some tax form is being generated and sent, and that information sent to the IRS. But if the IRS isn't stupid. In the off chance you were to get audited, all they're going to do is have to back up. They're going to say, hey, you're sending from your Coinbase account. You keep sending all this money to this one wallet. And then they're going to look and see, oh, that's your wallet. And then there's all this trading activity and all this income being generated. Like, they just have to move one or two steps forward to figure out what's going on. So that's where we'll start with everything. We'll get pretty aggressive and creative, but we always start with just freaking report the income, and then we'll see what we can do to knock it down.
Okay, so one of the things is like, a lot of people have made a lot of money off of NFTs and crypto, but a lot of people have also lost a lot of that money too. And I know we get into the idea of tax or loss harvesting and things like that. Can you explain that? Because I've heard some and you're gonna hear my dogs bark here in a second, but I've heard some combative, well, you don't actually have to sell it in order at a loss to include it. It can be included as quote unquote dead stock kind of things. Can you maybe go into a little bit more?
Yeah. So I had a client who sent me like a screenshot from some group where someone was literally trying to say, just treat it as dead inventory. You don't have to sell it. Act like it, just write it off as bad inventory. And then if it does recover, then you're able to, you still have exposure to the asset. You still are able to, you get that upside. And that doesn't make sense from just general accounting principles, but the IRS, we wrote an article on this, finally got around to doing it last week, where the IRS actually specifically addressed that. And the long and short of it is, in the vast majority of cases, you need to actually dispose of the asset by sending it to a null address using one of those services that allows you to send it to them to actually write it off. And the reason for that is that that's true disposition of the asset, because the IRS said in this not private letter ruling, but it's from the chief counsel's office. They said that if you're going to be able to call it worthless inventory, or worthless assets, you don't always have to actually dispose of it to take the loss. But for it to be a worthless asset, one, that's subjective. That's a subjective determination that the IRS could disagree with later on. And also, they said you have to wipe out not only present value. It can't be that the NFT is worth nothing right now, but future value also has to be completely just gone. So theoretically, you can just say, that's a dead asset, I'm going to write it off. The only time I'd really recommend that, especially now that gas fees are so cheap, the only time I would do that would be if you didn't do enough planning throughout the year and you've missed the December deadline and you forgot to send it. But it's really and truly just a dead project. Because otherwise you're just opening yourself up to exposure. And again, if you get audited, there's a decent chance that the IRS is going to disagree with that very subjective determination of worthlessness.
You keep saying, and you're very careful about it, which I love, if you get audited, because again, it's a rare thing. It's really only there when they're like, something looks really weird here, right? I assume.
Yeah, it's either when something just gets flagged in their system, or your name does just randomly get picked out of the hat. But the chance of being audited is less than 1%. So especially in the early days when we pick up just sort of anybody is who we'd work with. Now the clients we work with skew to wanting to be more aggressive because they're online businesses, they're crypto investors. But we have some clients where I swear it would be like every 3 to 6 months they'd be having some just panicked conversation, just sure they were going to get audited. And it's like they're literally losing sleep over it regularly. And what I would tell those people is your chance of being audited is less than 1%. So, and generally, unless you're just committing fraud, your worst case scenario is getting hit with the tax you have owed and a 25% penalty. So you kind of look at how they do insurance premiums, where they say, okay, you've got a 99% chance of not having a fire and a 1% chance of having a fire. And if you do have a fire, there's a 25% chance there's another fire going on and the fire department won't get there for 2 hours, and there's a 75%, and you just go through those probabilities, and that's how they come up with your premiums. And I always say, you got less than a 1% chance being audited, and unless you're doing really stupid shit, your worst case scenario is the tax you would have paid anyway plus a 25% premium. I'll take those odds any day. So normally that's my conversation is hey, be smart but don't worry about it. In the crypto world, I find myself being a little more of a fuddy-duddy, old school accountant, because people are have an absurd amount of risk tolerance that nothing scares them and they just want to go crazy with it. So I don't know, it's kind of a rambling answer, but it's not likely, but you do want to make sure that if you, in the off chance your name does get pulled out of the hat, you don't just have stupid crap that you've been doing that is either just going to, where they're just going to hammer you, and or it's so ridiculous that they're like, yeah, you might have actually committed tax fraud because you were so blatantly and knowingly, trying not to report this income.
Got it. And can you maybe walk us through, maybe you haven't experienced it yet, someone in the NFT realm, an NFT trader that maybe has gotten audited and what all they are requesting. Because I'm someone who bought a home recently within the past year with assets, crypto assets and NFT assets. And one of the things the bank made me do was show them MetaMask records and things like that. And I'm just curious, is that where the IRS is teetering to? Are they already doing that? Is that something they're building out infrastructure for?
We haven't run into it personally because of the decade that I've been in practice. I think we've had less than 10 clients get audited, and over half of those audits are sort of like, you put in air quotes, it's like audit, where it's done by mail, and the IRS is usually looking not at your whole return, they're looking at like specific component. Like they're asking people to verify their charitable donations or something like that. So it's pretty, that just shows you how rare it is. So we haven't run into anyone with that specific to NFTs or crypto yet. What we do know is that the IRS has largely been, they're really working on their AI. They're working on their systems to detect this stuff. And what people are making the mistake of is that they're saying, well, they're mistaking I haven't been caught yet with I can't be caught. And again, I'm not saying like you're doing the best you can to report your activity, and maybe you've got it right or maybe you've got it wrong. But some people just don't report anything, and the IRS hasn't hit them up yet, so they don't think there's any chance they will. Especially with all this new funding that the IRS is going to get, and they've been working on all these systems for detection for a while. It's going to become more prevalent. And the other reason that I tell people just to be careful, and again, don't lose sleep over it, but just make sure what you're doing, you've got a rational basis for it, is that the IRS, from what we've seen, has really just been trying to kick the can down the road because they're mostly waiting for Congress to give them actual legislation and regulation. Because the IRS can come up with guidance, they can sue people, they can do all that stuff. But they're a lot happier just enforcing legislation that Congress has passed, because if they, put their flag down and they draw a line in the sand, people are going to challenge it in court, and the IRS could lose. So then you've got the cost, you've got the embarrassment. So mostly they seem like they're just kind of in a holding pattern, just getting everything ready, but waiting for more explicit direction from Congress. So that's like not exactly what you asked, but to what you actually did ask. When they start their enforcement activity more, they're going to look at, you're going to have a platform, the good or bad, you're going to have a platform with KYC on it. And I mean, maybe you're mining and converting it to Monero and then doing it, like maybe you've got something where they can't ever track it, but for most of us, there's going to be a paper trail to something with KYC tying it to our MetaMask wallets. And the IRS absolutely is, they're not just going to look at your Coinbase account, they're going to look at the accounts that you're sending to, and then they're going to realize that those are yours, and they're going to look at all that activity and all the assets that are in there.
That makes perfect sense, I think. And honestly, well, I'm not going to say that. I don't want to incriminate myself. I'm kidding. No, I don't want to make the mistake of assuming that I know tactics, because I don't. And that's why you're here. We got a really good question here from EQ Poppy, and this kind of brings this conversation into another area that we've not discussed yet. But what's the best time to kind of start prepping for taxes? Because I can tell you now, we are in February, and I've literally been putting it off like it's the plague. Like I don't want to touch it at all. And I literally opened it up in Don't Cringe in TurboTax the other day and was like, this is going to be so much work. I'm literally going to do this last minute. So when should we start preparing for that?
I mean, ideally you're doing it in real time, and as basically the sooner you can do it, the better. Because if you're doing it as the transactions are happening or within a month or something, you remember what the project was, you remember what was happening. So when you're classifying that in Coinly or whatever you're using, it's not like this totally foreign thing that you're having to remember from a year ago. You're like, oh yeah, I did that, so that that's what that was. And then you're having real-time reports of what your profit and loss is looking like, the buckets of income, and then you're able to do good tax planning for it. So ideally, you're doing it in real time or pretty close to that. If not, then your best bet, if you're just not going to do that, which a lot of people aren't, you at least want to have all that crap done by like November, December, just because once the year closes, you lose the ability for so much of your planning and flexibility. We lose like 90% of our maneuvering once January hits. So if nothing else, try to make sure you've got that done by the end of the year so that if you do need to tax loss harvest or make different maneuvers, you still have time.
Which actually is a perfect segue into the second part of EQ Poppy's question was, could you maybe go into more about closing out expenses, losses towards the end of the year? Maybe give us a few of those, like that 10% of things that you lose when you don't have things figured out by then.
Yeah. Well, I mean, tax loss harvesting is the easiest example of that because right now, at least, crypto is not subject to the wash sale rule. Whether or not that survives the 2023 tax year remains to be seen, especially because with all these centralized exchange failures, it seems like regulation is coming faster than it would have otherwise. But like, so traditional securities, if you sell a stock for a loss, you're not allowed to buy that stock back for at least 31 days. Otherwise, they say, hey, you didn't really sell this. You just sold it on paper so that you could trigger a loss. So we're not going to allow you to take that deduction. Well, since crypto right now isn't considered a security, it's not subject to that. So you can sell your tokens for a massive loss and buy them back later that day, but you still triggered that loss. So unless you're going with that, you're going with that kind of aggressive stance of this is a worthless NFT, usually, well, sometimes tokens, but especially NFTs, just given the lack of liquidity. Unless you're just saying this is worthless, once the year closes, you don't have the ability to tax loss harvest anymore. And especially in a year where the first half of the year started off really, really great, and the second half was trash, or even 2022 that was mostly trash. Once the year closes, you can't trigger those losses anymore. So that really hurts in a year that you've got a lot of other income that you could have used those losses to offset against. But even in years where you don't have capital gains, it still can make sense to tax loss harvest because those losses, you can only use $3,000 of capital losses, like trading losses, against what they call ordinary income, which is your business, W-2, stuff like that. You can only use $3,000 to offset against ordinary income every year, but the losses just carry forward indefinitely. So we had a lot of people last year who didn't have taxable any gains. So we triggered hundreds of thousands of dollars of loss harvesting. Didn't help them much in 2022, but the losses are just hanging out, like waiting in the wings for 2023 or whenever the market turns around and they start having those gains again. And when they do have gains, they'll be completely tax-free because they've got all these losses banked up.
So you're telling me, so let's just use this theoretical example that I bought a house this past year and used $100,000 in a down payment that I got from NFTs and crypto, and fearing the amount of taxes I'm going to have to pay for that, I decided to sell some, I don't know, art blocks that went pretty close to zero after I spent, let's say that I quote unquote lost harvested like $20,000 to offset that. Are you telling me that I'm only able to claim $3,000 of that?
Against ordinary income. If you had $20,000 of capital gains, those directly offset. But it's just a different bucket. So and that's one of the things that can be hard, is that depending on the bucket of crypto income and how you're generating it, you can have people who have a ton of trading losses, but they've got a bunch of node income or mining income or play to earn or just staking or whatever. Those don't directly offset against each other, and it can really foul people up and really catch them off guard.
Okay, that makes sense. No one's ever explained that to me. See, Micah, this is already an amazing conversation because you know what you're talking about. I'm actually a tax expert, and I'm just been quizzing you this whole time, so appreciate it. Awesome. Well, guys, again, I questions keep hitting me as we go, but I would love for more questions to come from the audience if you guys have it. Micah, is there anything that maybe is usually asked in these conversations that maybe we can go off of? Any kind of questions that you've had recently that are really good ones that you want to maybe reiterate?
I mean, it really depends on the activity that the investor is involved in, because what really got me into crypto was Gala Games nodes, because I have a client who's involved in that project. So I love nodes. So with node income, there's a specific way that there's specific strategies around that. But if people aren't into nodes, that's completely useless to them. So usually it just depends on what people are doing. Like the activity bucket will kind of drive what it makes sense to talk about. I mean, we can talk about whatever, but I also don't want to go on a tangent for something that's irrelevant to 80% of the people listening.
Yeah, that's fair. We'll keep doing the questions from the audience and the questions that I come up with, because I just thought a really good one. Let's say I am ill prepared, right? I didn't really think about things. I certainly wasn't keeping money set aside for taxes and things like that. Are there any strategies post the tax cutoff deadline that I would be able to utilize or use that would help me kind of gain some more footing? Is there anything like that exists? Is there a magic strategy that oh, hey, I'm safe now?
There's a couple things we can do. Again, a lot of it has to happen during the year. But one of the easy ones that people weirdly will miss will just be the accounting method that you're using. Either if you're doing it manually or in the software you're using. Because what all these tax softwares or these coin tracking softwares will default to is FIFO, which is first in, first out. So it's when you sell a token, it's going to pull the first one that you purchased and the cost basis and holding period. That's what it's going to use. And there's good reasons for that. And for a lot of investors, that can be the right method. And the reason they'll do that is that if we're pulling from the oldest stuff that you bought, you're more likely to qualify for long-term capital gains. And long-term capital gains are just done at you've got a more favorable tax rate on those. So if you're just a buy and hold investor and you're barely selling, that can make sense. But especially if you're an active trader, you can do last in, first out, but really the one that makes the most sense for active traders is HIFO, which is highest in, first out. So if you're just trading quickly and you've got no chance that you're going to be you're never getting long-term capital gains anyway. We've had it to where we were able to knock down the capital gains by a couple $100,000 just by going into, I think the one guy I'm thinking about was in Coinly, and just changing the setting from FIFO to HIFO. And even if you do qualify for long-term capital gains, sometimes it still makes more sense to go with HIFO because, even though you qualify for the better tax rate, you're pulling something that had a cost basis of $1 instead of something that had a cost basis of 50. So even though the rate's better, you end up with, in absolute terms, with way more of a gain, and even accounting for that rate arbitrage, you still end up paying more tax on it. So that's the easiest one that weirdly people will miss.
Okay, and and you keep using the software Coinly, and that's actually what I used when I didn't know shit from Apple Butter last year when I was doing my taxes. Yeah. What tools out there do you recommend? Because I remember Coinly was kind of, when I used it, it was kind of like, well, hey, this isn't the perfect thing for NFTs right now. We really haven't done anything. Is there stuff out there that's better? That's kind of a hand-holdy tool, more like, I don't know, like a TurboTax for NFTs?
Not yet, and I use Coinly just because that's the one that comes to mind. But at this point, at least, they're like 90% the same. Like if you're doing like any coin tracker, cointracking.info, like any of those are basically doing the same thing with all the same benefits and the same pitfalls. I know that Richard and Peter will actually do like the crypto like bookkeeping for people. I think they use Zen Ledger just because it pulls the wallets more quickly than the other ones will, but they're basically the same, and especially with NFTs, they're not great. They're just not.
Got it. And we have Mindful who came in a little late, but and we kind of went over this a little bit, but I want to make sure we reiterate that too for some of the people that came in here a little later. All transactions are taxed, right? As if I take profits from an NFT but stay in ETH, I still report those transactions as the current price of ETH.
Well, you do it at the current price at when those transactions were occurring, which may be what they meant anyway, but just to like it's not like it's whatever the fair market value was as of the date those transactions were occurring. But yes, even if you don't cash out for fiat, you are every coin for coin trades, NFT for NFT trade, like any of that is still a taxable event every single time. And that's another one of the pretty basic pieces of advice that we'll give people, but that people don't do, is making sure that you're cashing out. If you're having realized gains or you're getting staking income or whatever, when you're getting realized income, making sure that you're cashing out at least enough to cover your tax bill, and just setting that aside in an actual FDIC insured bank account. Because what some people were doing, even if they were cashing it out, is they were throwing it into UST or they were doing it into Voyager or Celsius or somewhere. And in either case, you don't have access to that money anymore. A number of the people we didn't end up picking up as clients and in 2022 were people who had huge 2021s, but didn't do any sort of cashing out. So we had people who came to us who had 7 figures worth of crypto income, but they kept pouring it back into the projects that were making them all this money. And then, it's not, the overall market went down 50%, but it's not like they were doing this with Bitcoin. They were doing it in altcoins or NFTs, and those projects went down 90 to 99% in some cases. So you had people who had $1 million worth of income, which generated like $500,000 worth of tax, but their portfolio at that point was only worth like $50,000. So that's one of the things. So we tell people and one of the reasons why monitoring is really important. As you're having taxable income, make sure you cash out just enough to cover the tax bill and set that aside in actual fiat currency.
As someone who's paying for that here this year, that's an absolute.
A lot of people are.
That hypothetical house question earlier maybe a hint, but got a pretty long question from Jay. So let me try to see if I can get to the point there. Let me just read it. They've tried some software like Coinly, and everything is totally out useless. You make adjustments line by line. Probably wouldn't even be able to do it properly, or even close as would need to make a ton of adjustments that I can't remember. Sorry. That's what's the best approach in this case? Try to do a random adjustment, make up a number, and just get a report for audit purposes? Question mark.
What we'll do is we usually use the reports that you get from one of those softwares as a starting point, because they'll get you depending on what you're involved in, they might get you 50% of the way there, they might get you 90% of the way there, but they're rarely ever completely right. And you can theoretically adjust it within the software, but that can be really arduous. It doesn't balance out. Like, you can spend so much time trying to fix the software that what we'll usually do is you start with the report that they give you, then you export all of the, like, we'll usually export the transactions into an Excel file and just sort of like redline the things that it got wrong. Like, a lot of times it won't pick up cost basis for certain types of transactions. So we'll just kind of go through there and say, all right, every time that you did this kind of swap, it didn't pick up the cost basis. And we'll kind of just add up in aggregate how much it missed. So then when when you're doing your tax return, you're not reporting every single individual trade. You're doing it in aggregate. So we'll figure out, okay, how much cost basis did it miss? How much did it miss on this? And then we just redline the report and change that total number. But yeah, I mean, usually you use the report they give you as a starting point for tax purposes, and it's just easier than trying to manually do it. Completely manually do it yourself, because at least those reports are pulling the fair market value of the, your gas fees, the transaction at that point in time. If you're trying to do it from a freaking block explorer, just pulling the fair market value is going to take you days. So it gets you started. Just how close it gets you to the finish line is really contingent on your activity.
Got it. So THC has a question. What should someone do if they find a transaction they didn't report correctly or at all in previous years? Like, hypothetically, of course. Let's say it's really keeping you up at night. You don't want to get caught with, fraud again. I don't want to go to jail for this thing that I just completely forgot.
Yeah. Depends on the scope of it, I'd say. Like, if you forgot, you've got some random L2 that you generated $50 worth of income on, the IRS is probably never going to find it, and it's so little that they don't really care. The bigger it gets and the more substantial it becomes, the more likely you are to want to probably amend that. And that sucks, because if you do that, you're not only going to pay the tax, you're going to pay a 25+% penalty on it. So it really that's a case by case thing of what was the transaction, how did you miss it, and it really comes down to how big was it. Because the smaller the transaction is, the less it's more conspicuous. If, oh, I forgot about this 8 figures worth of income I got, my bad. Like, okay, that's harder to justify to the IRS. But if you reported 95% of your crypto income and you forgot to report a little bit, then it's much easier to say, okay, if in the off chance you do get audited, you say, oh, my bad, I forgot about that. Look at all this other stuff that there wasn't a 1099 for that I reported of my own volition. So it really depends on the specific circumstances.
Gotcha. Not to say this completely, but they give you a little leeway based on what you've given them. Like, hey, you told us half of this or most of this, you just forgot this one little part of it. Got it.
Yeah, absolutely. And in those cases, they're so much more likely to work with you versus if it's a huge amount and or you were clearly had no intention of reporting any of your crypto income.
So one thing that's maybe not crypto related, but it is like this finance bro, TikTok finance kind of thing that I'm hearing constantly. Matter of fact, my friend ended up doing it just the other day. She runs a small nonprofit. She utilized that one tax rule where you can write off a car, right? Or essentially, from what my understanding, write off a car. Now, the crazy thing is she didn't go for this, this very nice SUV that's a decent amount. She bought an Audi, and so in my head I'm like, how is that even possible? So can you maybe bring some clarity to that rule? Like can we just write off cars now, or what exactly is that rule? Especially if I'm a crypto trader professionally or by trade, there's no way I'm gonna be able to write that off, right?
Not for trading income. So what they're talking about is what they call Section 179 depreciation. So normally when you buy an asset, a piece of equipment, a car, something like that, you're depreciating that. For cars, it's over 5 years. So that's whatever the purchase price is, it's just spread out over that period. For certain types of vehicles, you're allowed to write off the entire purchase price in the year that you bought it. But there's a couple things with that. One, you need a business to do that, and two, it needs to be a business use thing. It can't just be that you buy like car for yourself and your business does not have it doesn't have anything associated with needing that vehicle at all. It's got to have a business utility to it. That being said, theoretically, like let's say that you mining income, node income, and a lot of times play to earn income, that's going to be considered business income. So theoretically, if you have a business, you've got a node business that's making a good amount of money. If you're buying servers, you're buying anything associated with that, instead of spreading that out, you can expense that all in the year of purchase. And it's a little bit of a stretch for a crypto business, but theoretically, if you're going around and you're speaking a bunch, you're driving all the time to meet up with your crypto contacts and doing all this stuff, you could, if you can legitimately claim that there's a business purpose to that vehicle, then yeah, you could buy the vehicle and expense it all to offset against all your node income. But just for trading income, that's going to get you audited in like 5 seconds, because you'd have to report it on a business schedule, and you're going to have $0 of revenue and an asset that you're expensing for 50 grand or something. It's just not going to pass the sniff test.
Got it. That makes a lot of sense. And again, I feel like fintech TikTok is one of those things out there. Someone had a really good question here in the guest question. Do gas fees count towards cost basis?
Yes, 100%.
Oh wow. Okay. Just because you're giving that money to the network to process transactions.
Yeah, that is part of your acquisition and disposition. So yeah, you get to include that.
Got it. Okay. And this is some fresh news, and granted, it's a rumor. So I'm just curious to hear your take on it. So the Twitter account Watch Guru, who's hit or miss sometimes, said Coinbase CEO says he's heard rumors the SEC wants to ban crypto staking. Any merit to that, from at least from your perspective, or do you think there's a leg to stand on from the SEC there?
I haven't heard anything about that. I mean, I don't think, and again, this is conjecture because that gets more into the pure regulatory side aside from the tax side. That would seem, what I could see is that they're trying to, if you want to stake, it needs to come into the fold of being a security and under the SEC's purview. Them just completely banning it doesn't make any sense, because even though staking in terms of mechanism and everything is different, it's essentially a dividend in a lot of ways. So them just saying that that's not allowed at all seems very unlikely. I could see it maybe that they're saying, hey, if you want, we think this is a dividend, so if you're wanting to do this, then you've got to come into the fold with us. But I don't know. I hadn't heard anything about that yet. I can't hear you. I'm not sure if that's me or you.
It's me. I wasn't holding down my push to talk button. I switched from phone to here. Sorry.
Okay.
It sounds like it's probably just some substantiated rumor, and someone heard this word and decided to use this word, and now it's just like circling around. But that's an interesting take. Thank you. I want to make sure that we're answering questions. I don't see any questions coming in, and of course I've kind of exhausted mine, but I do want to make like a takeaway here. So in 2023, we are into February, but we're still at the beginning of this year. Can you maybe give us like maybe 2 or 3 things that we can start doing right now to make sure that we are better prepared for 2024 and when we start having to report there, and any insight there that maybe some takeaways that we can have.
I mean, this is simple and goes over a little bit what we've talked about. Make sure you're keeping up with your tracking in real time as you're having taxable events. Make sure you're cashing out at least enough to cover your tax bill, and then set that aside just in a money market account, so that if the market goes up, that sucks because you lost some of the exposure and the upside. But at least then, if the market keeps going down, you don't have a big tax bill with no means to pay it. And then, just if you're doing your tracking in real time and you're setting aside the money, that's going to cover like a lot of what you would need to worry about. But also, if you know how much you're going to make, that can also inform investing decisions that you might decide to do when you know, okay, I'm really crushed it this year. I've got all this profit. Maybe I want a tax loss harvest. If your bucket of income is business income, or if you've got a side business, or that's your main source of income, it can inform the decisions you make within the other parts of your finances. If you say, hey, I've done so well, I'm in the top tax bracket this year, I need to get rid of some of this money. Even if you exhaust everything you can do within your crypto portfolio, if I'm having a great year in crypto, I'm going to look to my CPA practice to see where I can reinvest and burn some money to get that profit down, and then I'm just not paying so much in taxes. So a lot of the stuff will depend on your financial situation, where you're making money. It depends a lot on you, but if you're at least attuned to it and know what's going on, then it's really easy for you to make informed decisions then. If you have no freaking clue, and then we're doing it at the end of the year, end of the year, or when it's tax time, like a lot of us do, the chance to make those maneuvers has passed.
Excellent. Well, I want to thank you for that, and thank you for all the advice you've given us today. And hopefully this is, of course, as soon as it happens, I do that. Sorry if it's too loud. I apologize. I just tried to yell at him. Want to make sure you have time to plug company that you work for, that you currently are doing services for, but at the same time you have books and things like that. Where can we find you? Where can we utilize you as a person?
Yeah. So if people are wanting to work with us personally, our crypto website is cryptotaxcpa.com, which is what I've got in my shill that in my username. If people are just wanting some more general crypto advice, we've got the book we published, and the digital version of that is free. Mostly on it's everywhere, but it's free on Amazon. It's called Decrypting Crypto Taxes, and that's kind of just the way we did that was we had every chapter basically be frequently asked questions. Do I pay tax on this? How is this taxed? What do I do with this? So that way, if you're just kind of, you've got a smaller portfolio, or you just don't want to work with us, be like, hey, I'm wondering how to deal with this. If you go to the table of contents, hopefully there's an answer, or at least some sort of overview of the general landscape of how that particular crypto issue should be handled.
And for any Kindle readers out there, the book is accessible through Amazon's Kindle. I've read it, a little bit of it. I wouldn't say I've read all of it. That would be a really boring read.
Nobody does.
No offense.
Nobody does. It's not meant to be done cover to cover.
Awesome. Well, again, this is I think MVHQ working with you and doing these kinds of talks is really, really beneficial for everyone. So hopefully this recording goes out and reaches quite a few people. But we're happy to have you here, not just as a guest, but as a member. You've been awesome to
I mean, this is awesome. Like I don't utilize the membership the way I should, because one, I'll get too busy, and two, I'm just a trash trader. I'm a buy and hold and especially with the market being the way it is now, like I haven't done it, but this community is so freaking awesome, just in terms of the help people will give, the tier of investor. Like it's pretty great.
Excellent. Well, we think you're pretty great too. So everyone, that will be it for today. We'll hopefully have some of these tax talks with Micah in the future. But everyone have a good night, and don't forget to reach out to Micah if you have any questions on your taxes through professional means, not just, hey, Micah, can you do my taxes for me? Thanks. But awesome, Micah. Thank you so much, and I hope you have a good night, man.
Yeah, thanks, man. Appreciate it.